Okay, let's dive right into this explainer and cut through all that endless financial noise. Every single day, we're bombarded with screaming headlines, speculative hype, and these super complex strategies promising to make us rich overnight. But when you strip all of that away and just look at the actual numbers, the truth of how wealth is generated is much quieter, and honestly, it's infinitely more powerful.
So, here is a question for you. What if the absolute best financial advice is entirely boring? Trying to pick hot stocks or anxiously time the market almost always loses to a deeply boring, highly automated strategy. Our brains are naturally wired to look for excitement, right? We want to find that one golden ticket that completely changes our lives. But true wealth building just isn't a Hollywood thriller. It's actually incredibly boring, and that is exactly the secret. It's an absolute formula that rewards those who set up the right systems and then simply get out of their own way.
And this brings us to our greatest psychological blind spot. We naturally expect our money to grow in a linear, straight line, but compounding actually behaves like a massive, rapidly accelerating ski jump. For years, it feels like you're pushing a boulder on flat ground. You put in your hard-earned money and barely see a return. But if you hold on long enough, gravity takes over, the curve violently bends upwards, and that growth becomes completely exponential.
Let's look at exactly how we get there. Here's our agenda for the explainer. We'll start with the financial ladder, move into the catch-fire point, explore the index fund advantage, uncover the truth about leverage, and wrap up with the mathematics of survival.
Starting with Section 1, the financial ladder. This is all about the optimal sequence for building wealth. We absolutely must begin with the foundation, because what you invest in doesn't matter nearly as much as the specific mathematical sequence you use to deploy your money. It's exactly like building a house. You literally can't start with the roof. Step 1 is a starter emergency fund, roughly $1,000 to $1,500. Why? Because without a cash buffer, a random medical bill or car repair will force you to liquidate your investments. Once that's safe, grab that employer 401k match. Missing out on a 100% guaranteed day one return costs you life-changing money. Then aggressively wipe out your high-interest debt because that's a guaranteed negative return. And finally, target that Roth IRA.
When we examine the long-term math, the Roth IRA offers an incredible structural advantage. It completely avoids the deferred tax illusion of a traditional 401k. See, with a traditional 401k, the balance you see isn't entirely yours. The government actually owns a percentage of it, and they will force you to withdraw that money later in life just so they can tax it. But with a Roth, you're making an after-tax contribution. You pay the tax on the seed, not the harvest, meaning every single dollar of compound growth over the next 40 years is yours to keep, 100% tax-free.
Moving right along to Section 2, the catch-fire point, which is when your money actually starts out earning you.
$51,400. This is the exact moment compounding mathematically takes over. If you consistently invest $300 a month at a 7% real return, passing this specific crossover balance means the market is finally earning more in a year than you contribute from your paycheck. Just think about that for a second. At this threshold, your 7% return generates more than the $3,600 you sacrificed to invest that year. Your portfolio is officially doing more heavy lifting than your labor.
Now, there are 3 distinct rungs of compounding. You've got the starter floor where your paycheck does all the work. Then the crossover, where the market matches your paycheck. And finally, catch fire, where the market massively out-earns you. Sadly, most investors actually quit right around year 10, stuck on that flat starter floor. Because our brains think in straight lines, a decade of disciplined saving can feel super unrewarding. People look at their balances and think the system is totally broken, but they are quitting exactly one step short of the exponential explosion. If they just stayed the course, their account would soon be throwing off tens of thousands of dollars a year in pure growth.
Furthermore, part of staying the course means ignoring the urge to time the market. Historical data absolutely proves that consistently buying at all-time highs mathematically outperforms holding cash and waiting for a 10% dip. It feels so safe to sit on the sidelines with your cash when the market seems expensive, but while you wait for a crash that might take years to happen, inflation is guaranteed to quietly steal your purchasing power. Plus, you miss out on those crucial days of compounding. Time in the market always beats timing the market.
Okay, Section 3, the index fund advantage. Let's talk about owning the machine.
Once you have the right sequence and the patience to hold, the actual asset you own becomes the primary engine of your wealth. And get this, research shows that an incredibly tiny 4% of stocks drive all market wealth, all of it.
The other 96%, they performed essentially like boring risk-free treasury bills. This makes individual stock picking incredibly dangerous for your portfolio. The market's massive historical returns are entirely carried by a tiny handful of absolute monsters.
This is exactly why Warren Buffett famously bet $1 million that a simple S&P 500 index fund would beat a portfolio of elite hedge funds over 10 years. And the smartest, most expensive professionals on Wall Street lost that bet. Why? Because an index automatically guarantees you own that 4% of winners without paying exorbitant management fees. The index fund doesn't try to outsmart anybody. By buying every company, it guarantees that when the next Apple or Amazon emerges, you already own it. And it protects your compound growth by keeping fees basically at zero.
Next up is Section 4, the truth about leverage, the major accelerators, and the traps.
Now that we have the compounding engine humming, we need to understand the structural accelerators and traps. Because the moment you introduce borrowed money into your financial life, the entire math equation changes fundamentally. Let's look at Jake's real estate versus Marcus's gold. Think of real estate as a high-effort wealth machine amplified by leverage. You put 20% down, the bank multiplies your purchasing power by 5, and hopefully it's cash flow positive. But it is a time-intensive second job. Gold, on the other hand, produces zero yield, no leverage, it just sits there. But it acts as vital armor during inflation and market panics.
But never, ever forget that leverage amplifies both ways. If you buy a house with a 10% down payment, a mere 10% dip in that property's value completely wipes out 100% of your equity. Leverage is not magic-free money, guys. It is a massive amplifier. It will launch you into financial orbit if prices go up, but if the market turns against you, that same amplifier can permanently destroy your net worth in a matter of months.
We also have to acknowledge the massive, invisible elephant in the room, the bond market. This is a $130 trillion foundation of global finance. Stocks get all the flashy headlines, but bonds run the world. Bond prices move opposite to yields, dictating interest rates and signaling overall economic health. So when you see warning signs like inverted yield curves, which just means short-term borrowing is suddenly more expensive than long-term, that mathematically signals a tightening of credit. And when credit tightens, the era of easy leveraged money comes to a screeching halt.
Which brings us to our final part, Section 5, the mathematics of survival, avoiding zero.
Everything we've built so far, the ladders, the index funds, the compounding ski jump, is completely worthless if you get wiped out. To survive, you must consciously protect yourself from reflexivity. That's the psychological herd mentality where price completely divorces from reality just because everyone else is buying. When the cab driver starts eagerly giving you hot stock tips, the price is disconnected from reality. People are no longer investing, they are blindly following the crowd. And that is exactly when the bubble bursts. And here is honestly the most terrifying math in finance. Look at the math of recovery. It's brutally unfair. A 10% loss requires an 11% gain to fix. But a 50% loss, you need a 100% gain just to break even. If you chase massive, risky returns and lose 90% of your money, you need a 900% return to get back to where you started. And a 100% loss, game over. 40 years of compounding destroyed instantly. Avoiding absolute zero is the single most important rule of the wealthy.
So knowing the real math of how wealth is actually constructed, you have to ask yourself, is your financial strategy built for the straight line or the ski jump? Will you let emotion and daily noise dictate your future, or will you trust the undeniable architecture of compounding? You literally have the blueprint now. You know the exact sequence to deploy your capital, the mathematical danger of timing the market, and the absolute necessity of staying in the game long enough for compounding to catch fire. The blueprint is in your hands. The only question is, are you ready to start building?